on Asian equities last year, but they haven't been performing well so far in 2013. Has your stance changed?
I think it's an important question. As you say, last year was very good for Asian equities, best performing of the major regions of the world. It then becomes a relative game as we look into 2013. And I think one of the things that we saw towards the end of last year was a very strong run-up in China with a lot of confidence. You could say that that has dissipated going into the beginning of 2013 as people are beginning to look forward and think about, are the earnings going to be coming through in Asia, as had been the expectation in the fourth quarter of last year. While you've had that going on, you've had a news story in Japan, which continues to perform very strongly. The United States economy is doing well, and you've definitely got momentum there. So in terms of what we're doing, we've taken a bit of money off the table in Asia. It's a region that we like fundamentally long term, but at the moment we think that you're going to get better returns in places like the US.
Developed markets in Japan have been the outperformers so far this year versus the emerging markets. Why is that?
I think there's a couple of things that's been going on there, and the first thing is when you have a look at the markets that have been doing well, they're markets with big installed domestic savings bases. So Australia has done well, the United States has done well, Japan has also done well, but with respect to Japan, that's been more about foreign investment coming into an under-owned situation. When you look forward, people are looking for earnings certainty. Earnings trajectory in the US is actually pretty good. I think you're going to continue to see reasonable momentum in Japan, and what we're waiting for in Asia is an earnings follow-through. So provided we actually get some pick up in earnings momentum in this part of the world, what I hope to see is that Asia begins to catch up some of the ground that it's lost in the first quarter.
Experts expect the U.S. economy to clock at 4% GDP growth this year, and the U.S. stocks are trading at near record highs. Do you see this factor limiting fund flows into emerging markets, and why?
Look, I think the reality at the moment, and we talked about this earlier in our conversation, is that a lot of the money that is coming into the markets is domestically focused. I think when you have uncertainty in the world, as we do have, people will back transparency and certainty over opacity and uncertainty every time. So yes, I would continue to expect that you'll see good flows into markets like the United States, and as those markets become more highly valued and we see an expansion in the PE multiples, then that will encourage people to invest more in the emerging markets. But at the moment, what you're getting is a pretty good deal investing in a place like the United States. Politics is basically settled. The big decisions have been pushed further down the road. Yes, we've got the impact of enforced government cost cuts, but they are going to take place over a 12-month period of time. And when you have that sort of scenario and you have the guarantee of lower rates, you know that policy and corporate ambitions are aligned. And that will serve the stock market well.
Mr. Simon Flood, thank you so much for joining us for this interview on ET Now.
Thank you.